Oh, can you believe that it's already the middle of December? It's almost December 15th. It's December 12th. Incredible. This year went by so fast. Tonight, I'm going to be talking about the all weather strategy, Alpha Guard, and Inflation Guard, and Alpha Focus, and the different strategies that we've brought to Phenomena over the last few years. It's a good chance to look at the year gone past, but also to think about what's going to happen in 2024. Today, I'm going to talk about my prediction of who is going to be the next president of the United States. I'm going to talk about how I come to this conclusion. And this is some research that I've been working on. And I'm going to tell you some of the themes and ideas that I see going on in 2024. But before we do that, my name is Andrew Stotz, and I'm happy to be here with Phenomena to meet all of you guys and say hi and to talk about markets, investing, and how we manage our money and how I look at the markets. My work is basically thinking about asset allocation and providing that to Phenomena. And that asset allocation then you can access and learn more about. So it's great to see everybody. If you got your hands free and you're not in the car, make sure you say hi. And I see Dan Tan. So hi, Dan. And for the others, make sure you say hi and stop in. Toss up on. Good afternoon. Yes. In fact, good evening. Make sure you say hi. And most importantly, as we get into today, make sure that you're asking questions. I love tough questions, difficult questions. They make you think. They make you think what's going to happen. And so feel free to ask any questions as I go through tonight's presentation. Most importantly, enjoy the presentation and hopefully you can gain something from it. So I'm going to share my screen and start the presentation. Remember, you can ask questions as I go through the presentation. So let's share that screen. And here I am. So we're looking at the November performance of All Weather Strategy. And again, remember, you can ask questions in the chat about anything. I love your questions. So our asset allocation strategies are global and they're long-term and they're diversified. Those are the three things that we're aiming for with the strategies. Many people these days don't like Thailand. They think there's no performance going to happen in the Thai market. Well, this provides you some opportunity to invest outside of Thailand. But most importantly, it's important to remember why we're here. We're here to build wealth over the long term. And I see three pillars of investing. First is to be broadly diversified. Second is to contribute regularly. And third is to stay invested. If you do those three things, you've done the core of a great investment strategy. I outline this in my book, How to Start Building Your Wealth Investing in the Stock Market, which is available in English and Thai at bookstores in Thailand, also on Amazon. And I also have it as an online course. Now, our goal is to deliver steady returns over the long run. You can see our three strategies that we have with Phenomena. The red line is All Weather Strategy, which we launched in February 2019. And we're targeting 6% per annum return. We started All Weather Alpha Focus in October of 2021, and we're targeting 8% return. And finally, we launched All Weather Inflation Guard, which we did in July of 2022, and that targets a 4% average annual return. The objective of Inflation Guard is for those that are really, really conservative, but want to pick up a little bit more than what they're getting in the bank. Those are our goals for the strategies. There's no guarantees, and it can be tough sometimes trying to achieve those goals, but we're investing following those goals. So from when we started all-weather inflation guard in July 2022, the strategies are performing almost as expected. The moderate risk AWS has had the highest return, and the highest risk, the alpha focus, ranks lowest. Of course, it can happen due to higher volatility. The blue line tends to be more volatile because we're taking more equity risk. When you take more equity risk, you run the risk of not performing that well for a period of time. And of course, inflation guard has the lowest volatility. That's the green line. Now, if we add in the equity, we can see that since July of 2022, all strategies are below world equity, but with lower volatility. World equity has massive volatility. In fact, let me just grab my pen and I'll highlight the volatility on the downside and the volatility on the upside. And when you invest in any one of the all-weather strategies, you're getting rid of most of that, a large portion of that volatility. Now, we create our strategies for many decades, but not even a decade is long-term. This is me when I was born. This is when I arrived in Thailand, and this is going to be me when I'm 100. I ran into an old friend the other day, and he said, "You haven't changed at all." Well, I've changed since I came to Thailand, for sure, but our aim is to create strategies that perform over many decades. So we're going to do a performance review and look at new weights in our strategy. And all-weather gained about 6.2%. Alpha Focus about 6.4, which is as it should be. They should be getting a little bit higher return in Alpha Focus. And Inflation Guard gained a whopping 4.2. Pretty amazing for the month of November. We're going to talk about the global outlook that guides our asset allocation, and then some ideas that I'm thinking about for 2024. So first, let's start with all-weather strategy. Here we can see we've been 85% in equity and 25% in US, 25% in developed Europe, and 25% in Japan. All other positions are 5%. So we're not defensive for sure. We've been aggressive. And since inception, the strategy was up 28.6%. And that's about 10.6% above a 60-40 portfolio. Remember, this is after fees. Here we can see that in November, the strategy was up 6.2%, which was 0.4% below the 60-40. So we slightly underperformed, but we didn't really underperform when you consider it on a risk-adjusted basis. The US and developed Europe equities were the best performers, and we had 25% target allocations to both. Now, while Japan was up 5.2%, our 25% target allocation was a drag on performance relative to the 60-40. Japan was one of the ones that we got hurt in, but really, I would argue it's not that particularly painful. So it's time to announce our new allocations. We've already sent this to FINNOMENA a couple of weeks ago, and it should be applied to all portfolios. Well, no change. We're keeping it right the way it is. We're going to maintain 25% target allocations to the US, developed Europe, and Japan within equity. Now, before we go on to Alpha Focus, I'm going to just switch over to the presentation, and I just want to mention that, hold on, let me just get myself up there. All right. Feel free to ask any questions as I go through this presentation. There's no question that you can ask that I wouldn't welcome. So feel free to ask. No Nickname says, Santa Claus is coming at year end. Yes, can't wait for Santa. In fact, in my house, I have the Christmas tree up and we have lots of Christmas decorations. So for those of you that do celebrate Christmas, I hope that you are celebrating nicely. Also, Recrock, good to see you, and thank you for commenting. Make sure that you say hi in the comments, and also you ask questions. What's the point? Hopefully you can learn more stuff by asking questions. So feel free to ask questions. All right, I'm going to go back to the presentation and let's see what we're going to look at next. We're going to talk about alpha focus, the strategy that's more aggressive than the all-weather strategy. Now, right now, equity is at 68%, bonds is at 13%, and 19% in gold. That is the previous weighting. And we can see that since inception, the strategy was down 9.6%, but 1.8% above a 60-40 portfolio. And here we can see it's just about 0.1% above world equity with a lot less volatility. Again, you see world equity having a huge amount of volatility, particularly on the downside. In fact, in this chart, there was no upside volatility except maybe a little bit there and maybe a little bit there. But even in those cases, particularly in this one, Alpha Focus captured that upside. So here we can see in November, the strategy was up 6.4%, which was 0.1% below 60-40. So about in line with 60-40 for the month of November. Now, I don't look at the month of November with much confidence because I know that it can be noise. If you just look month to month, day to day, week to week, you can get caught up in the noise in the market. And I spend a lot of time making sure I'm not caught up in the noise. So the strategy was 1.9% below world equity. As you can see, world equity was 8.3. But out of our bigger tilts, only infrastructure did better than world equity. So again, we're going to announce our Alpha Focus new allocations, which have already been applied to portfolios. Lots of changes. First, we've increased equity to 95 from 85. Or sorry, from 65, I think it was. Yeah. 68. As we can see right there, 68 to 95 in equity. We're increasing Europe small caps and Infotech to 22% respectively. And we're adding 22% to energy. We're reducing healthcare and infrastructure, bonds, and gold. And we're exiting Latin America, where we had a small position. These are the changes that we've implemented. Let's look at inflation guard. But before we do, I'm going to come back and say hi and make sure you're asking any questions that you may have. No Nickname says, why U.S. market is up so much? Is it a bear trap at the beginning of a bull? Will it continue? Well, right now, Americans are thinking that the Fed's not going to raise rates. In fact, they're going to start cutting rates. And if the Fed starts cutting rates, then the market's going to go up. And so I think that's, one factor. Plus, U.S. corporate earnings have been strong, and jobs number have been strong. So people are still excited about the market. But remember, that's why they call it a market peak, because at the peak, everybody's positive about the market. Are you positive about the market? Are you negative? Where do you stand? Well, that's the benefit of our FEMR framework, is that it takes some of my emotion and judgment out of the stock selection or the asset allocation selection. And it helps me to really focus to make sure I don't miss something. And that's the benefit of the FEMR framework that we use. All right, I'm going to go back to my presentation. And we're going to talk about how inflation guard was up 4.2%. So only 25% was in equity and 70% is in bonds. Here we can see that since inception, the strategy was up 2.9% and 7% above the 40-60 portfolio, meaning 40% in bonds. The strategy has also less volatility. Here we can see the strategy was up 4.2%, which was 1.5% below the 40-60. So a little bit of underperformance, but still relatively strong positive. Our 5% target allocation to world IT did great, and the World Equity Fund underperformed the all-country world index. Gold, tips, and money market funds dragged on performance. All right, let's announce our new portfolios allocations, and these have been applied already. We're keeping equity at 25% in this strategy, and we increase tips and gold by 5%, and we reduce global bonds by 10%. So I'm going to stop there, and if there's any questions, make sure to ask those questions. I would say it was a tough year for managing money, but the thing that is critical is to stay calm. And I see a lot of people in my life panic when they're in a difficult situation where they're losing. You know, you don't have to worry about panic when you're winning because it feels great. It's when you're losing that you panic and do the wrong thing. So it's important to, make sure that you're careful in your investing. And that's part of what I try to do with the different strategies is blend in some bonds and some commodities and some gold with the objective that it balances out the strategy. All right, let's continue on. And I'm going to go back to the presentation and look at some global outlook. Central banks continue to battle inflation while trying to avoid a severe recession or banking crisis. Do you think there's going to be a recession or a banking crisis? The recession versus no recession debate continues, and sentiment seems to be in favor of the latter, meaning no recession. And the Fed and ECB might be done hiking, which could support equity, and that's part of what's driving the market. The 3-month government bond yield has risen to 5.9 from 4.4. That's a pretty huge move. Central banks are battling inflation while trying to avoid a severe recession or banking crisis, and rates have come up quickly and inflation has come down. So we expect continued pauses in the near term. Now, yield curve inversion has dived deeper, and we're seeing a turn happening. Of course, all recessions in the U.S. since 1968 were preceded by an inverted yield curve. The average time from inversion until the recession started was about a year, which is one of the reasons why I say we're going to have a fourth quarter economic recession. Now, it hasn't come yet, but I believe it's on its way. If it doesn't come within the fourth quarter, I expect it to come in the first quarter. And when that comes, the Fed's going to release a tsunami of buying in the bond markets and in the stock markets. And that could cause the stock market to go up. Recession likelihood or a recession, and then the stock market goes up. That's the idea. Now, the market's pricing in a 98% chance of the Fed announcing a continued pause tomorrow. And it would be positive for equity. The market expects Fed to start easing in May. We can see May right here on this chart. And that'll be the first year that it goes down quite substantially. So a week ago, investors thought rates would be lowered in March. But falling rates typically have an expansive effect on the economy. It should spur economic growth. Now, for the past year, we've said that we think the course will be reversed. And I still think central banks will reverse course and return to accommodative policies as soon as something breaks. The massive rise in rates will eventually break something. And when the Fed turns negative and markets and economies start weakening, I expect the Fed will reverse course and bring rates back to zero. Not many people think that the Fed's going to come back to zero right now, I suspect. Do you? This reversal could support the U.S. market. Now, the U.S. still dominates the global financial markets, of course. The market cap can show resilience with massive and well-capitalized companies. And so we keep a 25% target allocation in AWS. And the U.S. is then about 30% of total equity allocation, which is still significantly below the 62% weight that the U.S. is in all country world. A no recession scenario appears to be priced in, which constitute a risk if the Fed fails. Here we can see Japan and EU trade is now, let's say, the red line is the U.S., and that's the CAPE ratio, meaning cumulative annualized PE or annual or compounded annual PE. But it's not really a growth rate. It's just a CAPE ratio. So European inflation is coming down. ECB passed its hikes in October and indicated that it could be peak. And EU companies are resilient. They're used to operating in sluggish growth and being a global leader in industrial tech automation. The EU could benefit from reshoring. And investors have low expectations for developed Europe. And we see a chance for the regime to surprise on the upside. And so we're keeping a 25% allocation to Europe in AWS. Now, small caps typically outperform better in a recovery, and Europe could surprise us on the upside, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. And so we're raising our Europe small caps allocation to 22%. That's the key. Now, a strong US dollar hurts emerging markets. We can see the strong dollar in the red bar or the red line and the performance of emerging market countries. Now, it's not always a one-for-one type of relationship, but you never get that. Now, if the US starts to strengthen further, it would be negative for emerging markets. Now, some reasons why a strong dollar is bad for emerging markets are when emerging markets borrow in dollars, it's more expensive to service and repay. And the cost of imports of capital goods and commodities can rise, depressing margins, and pushing up the price of exports. Investors move to US dollars when risks are rising, bringing dollar strength and emerging market weakness. And a strong US dollar may cause local central banks to defend their currencies by raising interest rates, which can slow the economy. Now, China's in trouble. It continues with an easier monetary and or fiscal policy to stimulate the economy. It's unclear if the Chinese economy has bottomed yet. Even with a strong dollar, Chinese stocks could underperform due to geopolitical risk. Now here we can see China's heavyweight in the emerging markets in Asia ex-Japan. That's the key to this chart. Now, we have 5% in emerging markets and 5% in Asia Pacific, excluding Japan. Now, Japanese companies have been hoarding cash over the past decades. They're now sitting on about $2.2 trillion in cash that's available. This opens up for share buybacks, investments, acquisitions. Now, improved corporate governance has reduced Japan's valuation discount. Japanese regulators and the stock exchange are reinforcing its corporate governance policy for companies to improve, like enhance profitability and bring clarity into cross holdings. Or companies could potentially be delisted if it shows the capital isn't used efficiently. Or you have the changes have already started to show in the market performance and foreign flows. Now, the high inflation in Japan means the private sector is being pushed to spend and invest. Higher inflation can lead to private investments and higher consumer spending, not to lose purchasing power. So let's talk about tax incentives for individuals. Japan improved its tax-free stock investment program for individuals, which is called NISA, N-I-S-A, and they're tripling of their annual tax-free quota to about, let's say, $24,000 and for an indefinite period instead of the previous 5. And Japan households sit on more than 50% of assets in cash and deposits. So we're likely to see more households investing in the stock market with the currently low bond yield. So we're keeping our 25% allocation to Japan in AWS. Now, what about oil? Here we can see that oil prices have been bottoming out. And while losing some momentum, oil price still has some technical support. Even without a significant rise in oil price, the energy sector can remain highly profitable at current levels. Now, what's a green transition? Well, here we can see a chart where we show oil consumption, and it's projected to reach an all-time high in 2023. I thought that the adults were saving the planet. If the world avoids a severe recession, oil demand is expected to remain strong. Now, demand is slightly going to outpace supply in 1924. And OPEC members agreed on 2.2 million barrels per day cuts in first quarter. So geopolitical tensions play out in the oil market where the U.S. is challenged. Now, the U.S. has drawn from its strategic petroleum reserves, but this was really a big mistake. Given oil prices had a large impact on CPI, it's high that oil prices are an issue in the Fed's battle against inflation. Now, see if I can find it. Now, what does this look like to you? What do you see when you see this diagram? What do you see? All right. When we see this diagram, basically what we're seeing is how Joe Biden bought the 2020 midterm elections. He released the strategic petroleum reserve, and that pushed down oil prices. Everybody benefited. And then eventually the supply was out, and then things kind of went back to normal. So let's just see a question that we have. You anticipated an uninverted U.S. yield curve soon or stay inverted till the recession? I would stay inverted to the recession, because I don't think that the Fed can or wants to mess around with the long-term rate. And it's already, at this level. And so I would say that the inversion could last for maybe 3 more months, maximum probably 6 months. All right, let me go back to my presentation. So given oil prices' large impact on CPI, high oil prices are an issue in the Fed's battle against inflation. At some point, the U.S. is going to refill the strategic petroleum reserve, which could put upward pressure on prices. There's just less inventory in the world. Now, while drawing from the strategic petroleum reserves, oil production is at a peak level in the United States, and that's 13 million barrels per day, pretty massive. So expect the battle for oil price to continue, and supply-demand imbalance is supporting high prices, and geopolitical conflicts could lead to price shocks. We're adding a 22% weight to world energy in AWAF. Now, at least one thing that's different this time compared to the 90s is that many of the big tech companies today are quality companies and they're making high returns. In this case, I'm looking at return on invested capital, but almost any return. And quality stocks should do better in an environment of high interest rates. So here we can see Infotech has driven the market. This is the Infotech, the B Infotech, that's outperforming pretty substantially. And much of the year-to-date performance in U.S. market and others has been driven by tech. And the momentum driven by the AI can continue and basically raise our allocations. So let's look at bonds. They're typically a safe place to be. Global bonds bring diversification benefits to the portfolio. And in recessions, safer assets like government bonds typically have performed well. And though with high inflation, low yields could still lead to negative returns. And we generally don't allocate the bonds to speculate on the upside, but rather to use it to protect capital over time. Now, this is an amazing chart, and it shows that basically at about 35%, there was this, that's the correlation to world equity. That's a great correlation. You want it to be as low as possible. You want it to be uncorrelated. And this is the master fund of SCB Globe. Oil prices driven commodities in second half, and food prices have softened. So here we can see oil prices and every type of inflation-related sector is there. The S&P GSCI index has a 61% weight to energy, while many available commodities funds have 40% related to equity. Now, food prices have softened, and that's good news. If the trend continues, it would help to lower the pace of inflation. Adverse weather conditions could push up prices again. And the main upside in commodities would come from a supply shock, like adverse weather or some sort of external demand. The main upside in commodities would come from a supply shock. And we're keeping a 5% minimum allocation to AWS and no allocation in Inflation Guard and Alpha Focus. Now, central banks have been loading up on gold, maybe even switching from US dollars. Gold protects value in times of uncertainty and market downturns. Here we can see the quarterly, or sorry, I think this is annual. Let's see. Yeah. The annualized or annual data for metric tons and the amount of gold that's being held. And so there's still a gap, but that could be delivered, gold that's bought but not yet delivered. And here we can see the movement that's happened in gold. It's not a huge movement when you look at it this way, but maybe it has a center of gravity about here. So central banks' aggressive rate hikes in QT could crash the markets. This is a risk. And continued rate hikes globally could lower bond yields, as higher rates mean lower bond yields. And if inflation reaccelerates, we could miss out on rising commodity prices. So this is some of what I'm thinking about right now. And I'm just going to stop sharing my screen. And not yet, actually. I'm not going to stop sharing my screen. I'm going to go through something here. And that is, we're going to have Q&A in just a minute. But the next Valuation Masterclass Bootcamp starts on the 13th. On the 18th. Really excited to bring this out. And students say it's well-designed progression of learning material and material created by number one analysts so that you understand what to focus on and engaging in fun lessons to keep your learning on track. Then there's practical assignments. A team of professionals provide guidance. An intense schedule of assignments and activities will keep you focused until completion. And finally, our supportive community of all of like-minded, driven financial professionals will inspire you. So if you're interested in taking this course, put your name in, scan that QR code, put your name in, and then put out your real name so that we can follow that. All right, it's Q&A time. I'm going to turn off the screen and let me know if you have any questions. You anticipate, okay, yeah, we already answered that one. This one, why is U.S. stock market up so much? Is it a bear trap or beginning of bull? I think there's a lot of things. You have to remember that the stock exchange represents all of America. And so I feel like, hold on. All right. Let's look at the next one. No nickname says, India, no allocation or valuation. Correct. We're not buying India right now because we're running our portfolio, and I don't want people to see, the Indian allocation, you'll notice, has not been in the strategy for a while. And the reason is because on an FVMR basis, we just haven't been able to come up with enough attractiveness of the Indian market relative to the other markets. And that's the reason why India isn't in. Any other questions? If you've got questions, now's the time to ask. All right. Any questions, feel free to ask. I'll take this question off. All right. So with no further questions, I'm going to stop there and let you get on with the rest of your evening. And I hope you enjoy your evening and you enjoy your Christmas and your New Year's. And I look forward to seeing you in the new year. And rest assured, over the new year, we're still thinking about the portfolio and our performance. All right. Have a great evening ahead, and I'll see you soon.